We got two very important inflation reports. We had Jerome Powell speaking this week, and we got two different stories out of the CPI. Kind of like with the stock market and Bitcoin. You know, they have a positive correlation. These are both inflation reports. One showing inflation cooling. The other is showing inflation overheating with the producer on the producer side there with the wholesale inflation. Between the S&P and Bitcoin. Bitcoin has dropped 27.5%, yet the S&P and the stock market are rising to new highs. They have a positive correlation long term. Which one is correct? I think we're about to find out, but the S&P and NASDAQ are going to now play catch up with Bitcoin. Bitcoin's probably going to bottom, some kind of rebound while the market plays catch up. Some bullish signals on Bitcoin. If you want to watch my latest Bitcoin video, I'll link it at the end of this one if you're interested. I know some people don't care for cryptocurrency. That's fine, but it's giving us a huge message here too. Which is right? Is the CPI right? Showing that inflation is cooling, having the year-over-year numbers come in lower than the expectations, 3% to 3.1 on the headline, 3.3 to 3.4 on the year-over-year. These are yearly for the core, and then again 3.3 below the 3.4 previous reading, 3% below the 3.3%. The headline year-over-year for the previous reading. So again, a cool report, negative month-over-month on the headline number, negative 0.1%, very low for the core, just 0.1% there. Again, below the previous readings, below the estimates. So we got a very cool report, but yet the market sold off. So we had the PPI inflation data come in, and that came in hotter than expected. Market shrugged it off. We had a rally. The rally was sold. Have Jerome Powell speak again on Monday. And again, we're likely going to see delayed reaction to this news coupled together with Powell. We're seeing warning signs of a turn with NASDAQ. Likely peaked and now turning down for a lower high with today's rally. It's about rallying back up and getting a Fibonacci retracement in Thursday's video. I'll show you that chart. The month over month come in at 0.2%. It was forecasted at 0.1%, so it came in hotter than expected. The core month over month came in at 0.4%, expected to be 0.2, so it came in hotter than expected on a month over month on both the core and the headline, and the previous was 0, so it came in hotter than expected. Then the year over year for the headline number also came in hotter than expected, 2.6. It was supposed to be at 2.3. And the 2.6 is higher than the 2.2, the previous reading, year-over-year basis. The core also came in hotter for a year-over-year core reading. The forecast was 2.5. It came in at 3%, and that's higher than the 2.3. So we got this really hot report. We're getting a cool report, a cool reading on the CPI. The market sold off with the cool reading, rallied hard on the hot reading. We saw a push down with futures, and then it got a bottoming tail, and we rebounded back up, and we saw the market begin to take off. The inverse head and shoulder patterns I talked about on Thursday at the 5-minute chart, they played out very nicely. We rallied up to the Fibonacci golden pocket on NASDAQ, rallied up to a new high on the S&P. I told you that was likely going to be the case. Show you those charts. Encourage you to watch this video all the way through. Things happening. In the week, we had Fed Chair Powell's testimony before Congress, where he said that the next move was likely not up for rates, but down. Again, we already have the central bankers around the world already having begun to lower rates. The Fed is likely going to do it in September, as I keep saying, and today's report is probably not going to change that. It's probably still going to be in September. Still think you're going to get 2 cuts, even though I said that the Fed would lower the amount of cuts to 1 or none. Market was not expecting, which they did do. Down to 1 with the dot plot. We're going to have Powell speaking during the market session on a Monday. And it very well could be that Powell reacts to this data, be a delayed response where we had a rally and then we got that late day sell-off with NASDAQ and NVIDIA, that we start to begin to get a bigger move down, especially as we're now going to be getting a lot of earnings coming down the pike. But you got Fed Chair Powell speaking on Monday, and then you've got earnings starting to now pick up next week. We had some of the banks get more, but we're going to start getting some of the big stocks on the S&P 500 going forward over the next few weeks. It starts picking up the pace of earnings next week. We get retail sales on Tuesday. We'll have some Fed speakers throughout the week. The day, before Powell speaks, before the market opens, we'll get the Empire State Manufacturing Survey. Watching to see if Powell says anything. Market just shrugged it off. Told you, sometimes the inflation data comes in and it defies logic. Times we've seen tops before at different peaks. Inflation data and good. We get hot inflation data, and yet the market rallies. Logic. I was looking at social media, and people were talking about the NASDAQ and NVIDIA and the different readings, some things. And one guy said, like it never happened. It's like a Thursday sell-off never happened. The sell-off is getting the ball rolling. NASDAQ's got getting a boatload of reversal signals. Is likely going to shift on Monday or Tuesday. My guess is it's going to probably shift on Monday, and we're setting up for that. I thought we'd rally up and likely get a lower high. S&P could still move to a higher high. That happened. Probably going to sell off early next week, Monday or Tuesday, probably at some point on Monday. It could be when Powell starts speaking. Market will open up later during the session at noon Eastern time. He will be speaking. Right here, I have the 3-month Treasury yield. The 3-month Treasury yield moves in lockstep with the Fed funds rate, the purple line right there. Again, we're flatlined right there. You see the purple line over here? This is the 3-month Treasury yield. Here I have the 50-day moving average with it. And right now, we're trying to cross with the 3-month. This is telling us a Fed pivot is getting ready to happen. It's telling us we're going to see recession coming. Fed pivot happened. The unemployment rate spike. A bear market start. That's what this is telling us. This time's different. You know, AI stocks, it's going to prevent any kind of recession and the stock market from declining. This is the same thing they said back with the tech bubble, the bursting of the tech bubble, and the dot-com stocks that all ended up falling by the wayside for the most part. The Wall Street darlings dropped 80 to 90%. You're going to see the same thing with NVIDIA. NVIDIA is going to end up collapsing the next bear market. Competition will come in and eventually bring their price down. NVIDIA, by the way, may have very well peaked in June, on June 20th, as we got the topping tail, the weekly chart. Now we're getting another topping tail with a lower high, and it's diverging with NASDAQ, which is a huge red flag. But just real fast, you start losing the 50-day moving average of the 3-month Treasury yield, signaling you're going to get a Fed pivot, like over here, like over here, and like over here. And again, when you get your Fed pivot, you get this, okay? When we get the Fed pivot, we're going to get this, and this massive bubble is going to come crashing down. Going to get a lost decade like you did between 2000 and 2013. 2013, before we went and made new highs. A couple of crashes along the way. You lost a decade. Same thing that we had happen in the 1960s and 70s. You lost, 16 and a half years or so after the collapse in 1929. Go back and make new highs for 25 years later. It has these long periods of drawdowns, but within the long periods of drawdowns, you get the bull, or the bear, and then the bull, and then the bear. And again, you get these long periods of drawdowns where you really long-term negative returns or returns. Now, I'm not saying, here you every single year is a low return. You have it because it's a roller coaster. You go down, you go back up, you go down, and it's just this long, drawn-out period, like we had in the 60s and 70s, like we had here in the from 2000 to 2013, and it wasn't until we got over here until, again, we started moving out of this range. I'm telling you, this is coming. This is telling you recession is coming, and now we're crossing the 50-period moving average. This is telling you a Fed pivot is right around the corner, and a recession is going to follow. Remove the Fed funds rate down here. You can see it just a little bit clearer. Again, we're crossing that 50-period moving average like we've done over here, like we've done over here, and like we've done over here. And again, this is telling us that is getting ready to pivot. I believe it's going to happen in September. It's going to have a negative impact on the stock market. Again, the herd believes the opposite of that. The herd believes that the Fed pivot is going to the bull market with Bitcoin, give us the bull market with the S&P, and actually it's going to terminate the bull market. The fact that the S&P and Bitcoin are diverging from one another, and again, the cryptocurrency people didn't think this was going to happen. You have all cryptocurrencies just getting hammered, along with Bitcoin leading the charge lower. Like I said, Bitcoin's probably going to get a rebound, but it's already done the damage in the weekly time frame. The S&P and NASDAQ are right behind it. Over here, when the S&P in the lower window, it peaked, Bitcoin had already peaked and it had collapsed. Got a feeble rebound back up and then collapsed further to drop 52%, losing over half its value. Well, the S&P dropped 15% before we got any kind of rebound back up. And it's over, and it wasn't. Then we got another, on the S&P, we got another 22% drop from the lower high that set up. And then after this rally, we got another 19% rally. In totality, 27.5% from the top. And Bitcoin ended up dropping 78%. But this is what's coming for the S&P in the stock market. It's gonna follow Bitcoin lower. All these divergences right here that have led to significant drops with Bitcoin. Again, divergences between the stock market and Bitcoin have led to major sell-offs with both. That's exactly what you have right here, right now. Bitcoin and the S&P are diverging. This is a huge warning sign. The Bitcoin prices dropped 27.5%. The S&P has rallied. This is just from June. Well, Bitcoin went sideways in May and on into June. The S&P rallied in May and June. And again, Bitcoin collapsed. Now going into July and S&P going into July. Huge red flag. And NASDAQ just got a topping tail here, this in the weekly time frame. But we're seeing the yield curve begin to break out of this triangle here. And again, once it starts going up here and then come back down, you're going to see that happen. An inversion taking place. It's inverted right now. And what that means is that the 2-year, the shorter term rate, is higher than the 10-year. You have an inverted yield curve. And when it uninverts, you're going to have the recession. It's an indicator that correctly predicts coming recessions. It's still inverted right now. It's when it uninverts and then begins to pull back here. That's right before the recession hits, and that's coming. It's starting to move up now, breaking out of this triangle. If it starts to move up, we could see this begin to go down, the stock market begin to go down, as so often is the case. Market peaking either before the Fed pivot or with the Fed pivot, and again, just before the uninversion of the yield curve. People that keep telling us we're not going to have a recession, I believe this, okay? We haven't had it yet. And you got artificial stimulus. You got crazy government spending artificially propping up the economy. Jobs report, a good chunk of those jobs were government jobs. I mean, they are increasing the amount of government jobs right now. The unemployment, the Labor Department's having problems continuing to fudge the fake numbers that we're getting out of the Labor Department for the amount of jobs created. So they're having to create these. But I mean, there's a huge amount of government jobs. I mean, that away, that was 100, right around half, I believe, jobs created this last time around were government jobs. Again, these things are all predicting recessions. Like the Buffett indicator and Shiller P/E ratio are predicting that we're about to have a crash. When the Shiller P/E ratio gets to these extremes, it's always been followed by a crash. What has it been, 6, 7 times that it's I think it's 6 times or so. Maybe 5, just 6, whatever it is. When it happens, you get above the 30 level and you start moving back down. Again, it is predicting that the stock market major self. So I'm just telling you, look, recession's coming. Our market is coming, but we're in a topping process right now. And again, NASDAQ got a top and tail. Maybe it's done now. It peaked June 20th. It diverged with NASDAQ. Bitcoin's already crashed. And again, set with the most volatility usually leads. Bitcoin led in 2022, it peaked in 2021, crashed in 2022, and again, S&P followed, and it crashed 15% in about 6 or 7 weeks. See what happens. Look, I just want to continue to warn you that, again, we are about to get a Fed pivot, meaning that they're going to start lowering rates, okay? We've had the run-up with the Fed pause, and that's creating a topping process. About to get the Fed pivot. And the Fed pivot means they start lowering rates. Right now we're flatlined because they've stopped raising rates. This is the Fed funds rate. And when they start lowering rates, which is the pivot, okay, bearish for the stock market because they're lowering. It's because a recession is coming. The hot inflation data with the PPI. We're going to have Powell speak on Monday. There's probably going to be concerns. We'll probably see a delayed reaction. We've already started to see a late day sell off the last hour of trading. It's some kind of sell off, and maybe we get larger reversal if signals again all turn bearish and remain that way, and we see that happen in the weekly time frame. Like Bitcoin, we began to see it with the daily time frame, and then it spilled over into the weekly time frame. And Bitcoin lost the 20-week moving average and it collapsed. It's bottoming right now, though, in my opinion, and it's going to be a counter trend unless we can get back above that 20-week moving average, 100-day in the daily time frame. If you're interested, the latest Bitcoin video, I'll link it at the end of this video. Crypto people, they didn't think that Bitcoin could possibly go down, and now it's lost, again, 27.5% in just a few months, and really, way back up. And from the high that was made, it lost 25.5% just in the last. It took it 5 weeks from the peak there, about 5-6 weeks or so to get the thing. We're rebounding right now. Nobody thought it could happen, and it did. We got the weekly charts bearish. So again, we got these divergences, weekly time frame on the S&P and the nasdaq. So we'll be watching that. But look, we've gone flatline. The Fed has stopped. They have done the pause. Okay, they were with their rate raising campaign. Now they've paused, and now they're going to pivot. When they pivot, we're going to have the stock market peak either before that or with that, and be pivoting because a recession is coming. That's why, again, we got hot inflation data with the PPI. The recession that's coming is going to take care of the inflation. It needs a recession to resolve that inflation issue. But here in 2000, we had the peak, we had the pause, we ended up rebounding back up during the pause. We got a lower high in the summer of 2000. And by the time we got the Fed pivot in January of 2001, well, the market had already peaked and it had sold off sharply from the 2000 top. That was an election year, by the way. And we keep hearing all over social media, oh, market cannot go down right now. It's an election year. But remember, we have uncertainty around elections too. Fed did the pivot. They started cutting the rate cutting campaign. They're lowering rates. Stock market had already peaked in an election year, had already begun to sell off into the election, sharply declining. Now here, we have a similar situation in 2006 and 2007 that we have right now, and that is, again, we had the pause, and we had this big run-up, okay, sold off a little bit, and then went back up, and by the time we had the Fed pivot, the stock market peaked with the Fed pivot, began to lower rates on September 18th, 2007. A couple of weeks later in October, the stock market peaked right after that, just a few weeks later. Here it was after, it was the self-imposed shutdown of the economy with the pandemic and everything. But these right here, a pretty good idea that we're either going to have the market peak and begin to sell off ahead of the pivot, or it's going to peak surrounding the pivot. No, a pivot is coming, that they're going to start lowering rates. When they did, this happened. When they did, this happened. And so again, keep that in mind. Recession is coming. Just quickly, we got the unemployment rate recently. It's ticking up now to 4.1%, okay? The employment rate, when it begins to move off of the lows, begin to see the stock market peak. And talked about this. Here's a chart real fast. Again, we hit this low of 3.4%. We've begun to move higher. We have now reached 4.1%. You see these low readings and you begin to come off of them with the unemployment rate starting to tick higher. That's when the stock market starts running into problems. We had these low rates here, began to move up off of them, and the stock market peaked and it began to turn down as the unemployment rate turned up. Same thing over here. Again, you begin to move off of the lows in the topping process. When you begin to move off of the lows, you get your topping process. It was the pandemic, the self-imposed shutdown, but these were economic downturns that, where the economy moving into recession, and we had the bear markets. And you can see exactly what happened. We had the spike, the months going forward, we began to see the unemployment rate surge and the stock market turned down. They have a negative correlation, and as the unemployment rate dropped, the stock market went up. Right now, we have this turning up. So again, eventually, this is going to turn down, and eventually, we're going to start seeing the negative jobs. Now, just quickly, here's what's known as the Sahm rule. Sahm was a Fed official. She was an economist over there at the Fed doing work for them. Indicator bears her name as she developed it. Now, again, what this is a 3-month moving average of the unemployment rate 1 year ago. And as what happens is when you move up off of the lows by 0.5%, it predicts the recession. Right now we have a reading of 40.43. We're almost there. And if this goes 0.5%, it's going to be forecasting a recession right around the corner. As you can see, when it starts happening, rather quickly. The recession comes, and that's why the Fed is likely going to have to cut and play catch up the other central bankers that have already done so. But this has predicted every recession since 1970 correctly, every single one. And again, we're now seeing this turn up. So is what I'm trying to tell you. Can you see that, or am I cutting that off? Let me move it over just a little bit so you can see it better. Look, is what I'm telling you is that we're seeing this tick up. We're getting to the area where it's going to be forecasting the recession. It's coming. The inverted yield curve is already predicting one, along with some other indicators. But I'm just telling you, the recession is right around the corner. Now, one reason, let me just say this. Again, the Fed has raised rates. We should have really had it. But you got this crazy spending out of the government. Just quickly, let me just say this. We had artificial stimulus injected into the economy with the stimulus checks, 5-6 trillion. You had QE infinity, and you get those artificial stimulus. You get the artificial stock market rally and the artificial recovery in the economy. It's not real. And the Fed has reversed their policies, but the government has not. And they're taking a record amount of revenue. They're taking in nearly $5 trillion right now, and the year's not over, so it's going to be more. This tax revenue is going to be over $5 trillion in all likelihood before all is said and done. That's historic. Yet they're running a $2 trillion deficit already. So they're spending $7 trillion, and that's been, again, keeping the economy artificially propped up.